Welcome to our weekly market review. It's brought to you by Treasury One and ETM Analytics. As per usual, I'm joined by Treasury One's currency strategist, Cilliers. Andre, it's a bit of a time because the US government is still closed. I actually checked Polymarket just before we started, and the bets are on that the government shutdown will last at least until 16 November. By the way, there was a switch over of the past 24 hours. There was the most bets went for this week, and now it's shifted to past 16 November. So still a lot of uncertainty around what's going on, because we're flying blind practically. And the thing that's adding to the anxiety is we're watching the equity markets with one eye closed, right? Because it seems like a bubble. It keeps on growing and growing, and now everyone's asking, where's the pop going to come from, if it's going to come?
That's an interesting one. Good morning, Ilze-Marie. So the government is still closed, but tongue in the cheek, one should ask yourself whether a king actually needs a government. If I look at what happened over the weekend in America and all the protests and everything, then the government is still very much in operation, because we do have, certain information coming through on the Trump platform. But I think the important one is there's an upcoming Federal Reserve meeting next week. And the one eagerly awaited figure called inflation, which is very important in terms of the decision-making of the Federal Reserve Committee to make their decision on where interest rates are going, whether it's up, whether it's sideways, whether it's down, is the inflation rate. And it seems that in spite of a government's closure that's being prolonged now, that we will have an inflation figure this week. So the Federal Reserve will have some information to make their decision on and base it on. So that is an important one if you look at the path of the dollar and everything. But I think more importantly at this point in time for discussion is actually this lingering tension of a trade war between America and China. And the fact that there is no figures coming out, as you correctly mentioned, the stock market that just goes up and up and up. Now, you should bring all those things, monetary policy, a trade war, tariffs, everything, you should bring back to what is the impact on that going forward on the growth of the American economy, the income on a fiscal side, the tariffs, the inflation, the everything. So, there's a lot of important things that hangs around this one. This is the two biggest economies in the world at this point in time that's at loggerheads, and that this can go on and on for a long time. This is all about positioning each other in terms of their strength and their weaknesses. And each of them has weaknesses, each of them has got strengths, and they need to focus on their strengths before the other one focuses on their strengths to get this resolved. This is how I see it. And from an article that Richard had placed for us to read beforehand, it's clear that this thing, if you look at the general consensus, can carry on for the next 2 or 3 years. And that's important to take into account, because that means that we will have volatility for the next 2 to 3 years, but volatility that might be looking at pressure on the dollar rather than anything else.
Yeah, it is the one that keeps throwing everything into the air once you think everything was stable, because we had the meeting scheduled between Trump and Xi Jinping, and then China pulled the card with the export controls on the critical minerals. And it seems to be the trigger point for that, although the Chinese government has come out and denied that it was because of a memorandum of understanding that was signed between the US and Pakistan, who also, had frosty relations following that COVID operation from Islamabad. But it seems to be that has been the trigger point, because the US has gone out searching for critical minerals because they so rightly started realizing, well, wait a minute, China's been busy with a strategy for decades on kind of trying to isolate themselves and insulate themselves so that they're not dependent on the US, right? This is not something that happened overnight. And it feels to me the US has waken up a little bit late to the party, but they're trying. So they went to the likes of Pakistan. Pakistan sent the first shipment. China said, whoa, we can't allow this. We're going to enforce and announce these export controls. And all of a sudden, you have Europe who's freaking out. And it's not difficult to understand why. I mean, Europe have spent the better part of 2025 announcing that they're going to shift their economies from this welfare state into these defense economies, pouring how many millions of euros into developing defense systems. So what you're saying is spot on. We have these two countries at loggerheads. It seems like the relationship is almost irreparable at this point in time. And as these two fight, everything is pulling apart. But I fear that the US is a bit late to the party, because there's an interesting specific example that was very interesting to me, is that China has successfully decreased their helium imports from the US since 2022 from, I think it's about 70 to 80% to less than 5% in 3 years. So these kind of strategies of decoupling, especially from China, has been ongoing for quite some time. And now the US finds itself in a position where it has to make quick calls, quick decisions, and it's going to hurt. It's going to hurt the, at least in the short term, global markets, equity markets. We're seeing a lot of these upwards. So it's going to be interesting to see how it plays out for the next 2 to 3 years, because that effectively is also Trump's term that's left. So we've got that point on the other side, and how, who's going to come out on top. And for the rest of us, we're just trying not to get trampled, and hopefully we can find a midway of finding some strategic value for us between these two that's fighting. So it is, but it can continue for some time.
It can continue for some time. And if we look at South Africa and we look at our mining industry, and then it says one thing, that we are rich in some of these earth minerals that is being sought after by the US. So this could become, in time to come, maybe not immediately, but it could become an interesting point of discussion in our relationships with the Americas. It could become a bargaining issue in terms of trade agreements going forward and so forth. But I think in everything that we are saying here, to me, it looks like the dollar could be in for a bit of a rough patch. And, if I look at the gold price up at the higher end, and I've looked at that, and I've looked at who's buying the gold, and there's a lot of central banks buying gold. Once again, we must go back, and, you've mentioned how China was kind of decoupling itself from the US, making it less dependent. However, one should not forget that they have some $3.3 trillion of assets in terms of treasury bills, etc., that lies in the US, so that's not small change. But back to where I started with the gold price here,
Yes.
To me, that looks like a mistrust of relationships between two big economies. Moreover, a mistrust in what happens in America, a mistrust in the leadership in America, because it's been, over the last couple of months, been very erratic. Things are being said, things are being implemented, and then a week later it changes. So there's no consistency, and that makes people uneasy. This can continue. If you look at how things are gelling out, it could have an impact on a possible bubble in the stock exchange. All of that weighing on the US dollar. Now, closer to home, if everything weighs on the US dollar at this point in time, and monetary policy can be relaxed with lower interest rates. What does that say for the rand? What does it say for our economy? Well, if you look at our inflation rate, Mr. Kanyagu has very successfully brought this down to the 3% level. If you look at our trading counterparts, they're now standing with their target rates, biggest trading counterparts, at around 2%. That makes the differential only 1%. If successfully everybody keeps their inflation rates, over the last 10, 15 years, our inflation rate was a lot higher than that of our trading counterparts. And the buffer that took the knock every time over the years was the exchange rate to compensate for this big inflation rate differential. If these countries keep their 2%, reach their 2%, we stay on our 3%. The differential is only 1%. That could already immediately spell more stability for the rand going forward, because it doesn't have to be that buffer. A weaker dollar could add to the support of the rand and keep it at stronger and elevated levels, and that will aid Mr. Kanyagu in his 3% endeavor. So maybe we should start thinking that on the rand side, there's a possibility that we can go stronger and remain at stronger levels for quite some time, which definitely has an impact on exporters specifically and the way they manage their currency exposure.
Yeah, and then of course things can reverse if the bubble does pop. We could see some strengthening. But I know we must also remember that Trump at the beginning of his campaign was very adamant about, a weaker dollar is better for the US economy. So he might, I'm assuming he's quite happy perhaps to a certain degree of how things are turning out. But yes, there's a lot of nuances and a lot of cross currents flowing at the background. By the way, on the gold price as well, gold overtook the euro as the world's second largest reserve asset ever now. So, gold is having a field day in 2025. And if I'm not mistaken, they're expecting prices to remain bullish for the next year or so. So, it's going to be interesting. And I think there's a lot of cross currents at the background flowing that can be unpacked and needs to be monitored, whether that's an equity market bubble, whether it's the gold price, whether it's the trade dispute between China and the US. There's so much going on. And we're in quarter 4 already. I was kind of hoping that we're going to catch a breather, but here we are. That being said, Andre, I know you spoke about the rand, but and we know out of the US, it's kind of a deadlock situation at the moment, apart from inflation that's going to come out on Friday. Anything else? Perhaps the grey listing announcement that could come this week on South Africa, but what are we expecting for the rand this week?
Well, I think I've voiced my opinion on the rand already. It could be in for some good times, and it could be some bad times for exporters. And if I just look at the last week, the resilience of the rand, a euro that is approaching the 20 levels, it's been below 20 last week. Then it says to me that there's quite a bit of resilience in the rand, and it's benefiting. Once again, I think one of the benefits is our strong monetary policy, our very conservative monetary policy, and I think that will go ahead. So, yes, for the moment, I'm quite positive the rand will hold at these levels.
Look, a positive note for today's podcast. But we will keep on tracking the cross currents, and then Andre Cilliers, we will catch up again next week.
Thank you very much.